Right, hello and welcome to today's podcast. It's the 15th of June 2020. My name is Adrian Boothie. I'm the head of trading here at Trend Signal, and today we're going to be talking about the Fed and its little banana skin, if you like, on the markets last week. Second wave coming through, affecting the stock markets and the currency markets, commodity markets as well. Join me as ever today is Jerry Miller. Hello, Jerry.
Hello all. Hi.
So Jerry, do you want to kick us off? I mean, that was a massive fall last week, wasn't it? On that Thursday.
Adrian, the thing is, has all been sort of expected for a while. I mean, there have been headlines on the FT about hedge funds preparing for another big sell-off. A lot of analysts and economists saying that the stock market is almost disconnected with reality.
And yet it kept going higher. It's a bit like the stock market boom that we had been having, though. Everyone's talking about it, can't keep going higher, and yet it just does.
Yeah, that's right. And I think we've swapped a few ideas and messages on Skype and stuff over the last couple of weeks, and the fact of the matter is, investors are buoyed by the fact that you've got not only the US central bank or all the global central banks on your side, but you've also got governments spending unprecedented amounts of money. It's like you've got this almost like a put option to protect yourself in the form of these institutions, central banks and governments, and that's what's happened. But can only go so far. And you've mentioned, Tina, before now, as I have, that there is no alternative to equities, and there isn't. And that's what the central banks are trying to achieve. They don't want people hoarding money. They want people spending it, investing it.
Yeah. Well, they say that Tina's even more now, I'm trying to think of the right word now, than it was a few months ago, because interest rates are even lower now, even less arguments bonds about potential.
Going back to what you were saying, what the banana skin with the Fed, it wasn't really a banana skin, but it was certainly something that sort of surprised the market a little bit. I think a lot of participants knew or know that the economy's been through a bad time, but I think to hear that record low interest rates are going to be kept by the Fed until 2022 at the earliest, and it was a sort of quite a dire warning about growth and jobs altogether. That really sort of spooked the markets. And of course, the thing that really sort of perhaps at the straw that broke the camel's back last week was the another poor reading on these weekly initial claims. Not the monthly ones, the non-farm payroll, but the weekly ones that come in. Yeah, you can see there. I mean, some of the countdown to the
I wanted to have a quick look at this. We look at the countdown sort of every so often, don't we? And just showing it on the screen now, those that are watching, not just listening. We're going through to the 17th of March 2021 meeting, so just a bit shy of a year away. And that's 100% likely that's what's being priced in at the moment for no change. I mean, that's just as far as it goes on this webpage here. So you can look at the next 5 or 6 meetings, and it's nothing happening.
Yeah. And these forward expectations aren't based on some sort of poll or anything like that. These are based on the market, the instruments that are traded on the Chicago Mercantile Exchange. So they use the forward rates, and you can actually get further forward than that, but they become a little volatile, if you know what I mean. But the expectation is, not surprisingly, the market is sometimes at odds with the Fed, though. So what the Fed may say, we're keeping interest rates until, at zero until 2022, and you suddenly find out that the market's expecting them to raise them or something. But that isn't the case here.
Don't believe the guidance fully, but clearly they do. Yeah.
Correct. Yeah. And I think having cut rates the way they have done, I think the market has been in this sort of battle putting out the fires, and I think eventually now the market has seen the fact that this will cause the dollar to weaken, but not when you get a spike in volatility like we saw last week. That's where you saw a sudden rush into dollars again, all the safe haven knee-jerk reaction that you would normally expect to see. So that's sterling having had a good run up against the dollar, like the euro, Adrian, and then bang. I mean, sterling got affected as well by some pretty horrendous monthly GDP data on Friday. I mean, horrendous, expected really, not unexpected, expected, but still horrendous.
Yeah, I mean, we can see the calendar here. So on Thursday last week, we had those unemployment claims, as you said, which was pretty much marginally better than expected, pretty much bang on expectations. But it's that month-on-month 20% fall in UK GDP. And GDP, that's effectively the size of the economy, isn't it? Gross domestic product, Jerry. So effectively, the economy has shrunk by a fifth in the last month, and that's on top of last month's reading, which was what, about 5% or 5.8%.
Yeah, so you're talking about a quarter of the economy is contracted by a quarter in the last couple of months. But again, it's not unexpected because we told everyone to stay at home, not work. You're a quarter of the workforce furloughed, which means they're not producing any wealth at all. Well, we didn't really expect anything else, but it's still shocking when you get it. And the worst previous monthly decline was 2%. 2. So it's pretty shocking. It's just shocking across the board. But that's the sort of the effects of the success of the lockdown, if you wanted to call that. It's doesn't perhaps is a perverse way of describing it, but there's nothing else that we could have expected. That's the way it's going to go.
Yeah. Well, I guess on the plus side, we've got the consumer sentiment, which is slightly higher than expected. And of course, that's a measure. We talked about this last week, a measure of how people are feeling. And of course, how one feels is, how much you're likely to get your wallet out and start spending, isn't it? So it's more of a leading indicator as opposed to these sort of retrospective lagging indicators that a lot of economic data is.
Yeah, I guess if you could ask those people that responded to the University of Michigan questionnaire when this consumer sentiment numbers produced, if you asked them on Friday following the dump on Thursday, I bet they wouldn't be feeling so confident now. Remember, in the US, unlike in the UK and Europe, a lot of US, there's a big holding of equities. 35% of investments are held in individual stock holdings by retail investors. Nothing like that. It's about 15% here in the UK.
It's a very different thing. I mean, those listeners are not totally aware of the difference in the UK and the US. There's no real state pension in the States. There's a lot of employment pensions, and what tends to happen is people tend to manage their own pensions. So whilst we've got self-invested personal pensions here, we might put some people a lot of people don't actually bother with those. They just go with the regular pensions. Some people, when they do have a self-invested personal pension, they just put it into a few funds. Whereas in the States, they'll use exchange traded funds, but actually there's a lot more trading of individual equities. And of course, what that means is that a lot more people are more clued up about the stock market. There's a lot more actively traded stocks in the US than they are in the UK. And of course, when you're staring at your statements, we're not looking at in the UK at our pension statement every week as to what it's worth. Whereas if you're actively investing your pension, then you are going to be looking at it regularly on top of any other stock investments you might have. It's going to have a dramatic impact on your positivity and the way you feel, because you're constantly looking at the measure of the stock market. It's a huge yardstick in yardstick is probably the wrong word in consumer confidence. Absolutely.
Well, it is, absolutely. When people look at their performance of their portfolio, that fills them with a bit of joy. When they find that the economies have reopened, that fills them with a lot of joy.
And I remember when companies like BP were taking the big crash, sort of February, March, and people were saying, oh yeah, but that means petrol prices can be cheaper. Yeah, but your pensions will have taken a hit. Problem is, a lot of people don't care about that, but they don't know it because it's an invisible thing, because they don't know what proportion of their pension holding is in BP. And in fact, most people, if they're on a state pension, they get that anyway. It doesn't matter really what's going on with BP or other large companies. It's almost irrelevant to people's behavior because they don't know. They don't really think about stocks. It doesn't enter their frame of reference.
No, that's right. And as you say, the immediate impact on people is cheaper petrol prices. But who's buying petrol?
All this petrol's so cheap that I'm not buying.
I won't buy.
Filled up once in the last 12 weeks or something.
So that's made a big difference. But so anyway, Jay Powell, the chairman of the Fed, he was the one that sort of set the whole thing going last week, and I think it was as we've said, the sudden. I tell you what. Ordinarily, the market wouldn't have sort of perhaps fallen out of bed on the back of those initial claims, the unemployment data. But I think it was following on from the Fed, and it was like, oh, come on, give us some good news, give us a good, decent bit of data. And I think it was in line with the consensus, but I think the market was wanting something a bit more upbeat. And I think all it did, this data, whilst it was the consensus, I think it underpinned the message from the Fed the day before that things were going to be pretty dire for a couple of years. I think that's what just is like someone pulled the plug out of the bath, and wow, did it fall 6%, Adrian?
I think there's also a lot of sort of scared retail money in it, shall we say, that have been buying up on these highs. Just the fear of missing out, FOMO. And all of a sudden, the market starts sliding, and people just panic, don't they? It's not necessarily the experienced investors. It might be a lot of the new investors who are jumping into this once in a lifetime opportunity that was the stock market crash. And of course, they'll get into the stock market quickly, and they'll probably exit the stock market very, very quickly as well.
For no reason other than the fact that other people were selling it, so I'll sell it for the same reason they've been buying it, because everyone else is buying it.
Well, people don't want to see the gains that that they've had. They don't want to see them eroded, do they? Quickly lock in something that while we can, just in case another big crash happened, like February, March.
And another symptom of the sell-off, the VIX index we often talk about, the fear and greed index. Wow, I mean, did that jump? I mean, that was trading, gosh, I don't know, down in the sort of 20s, wasn't it? Maybe lower. But anyway,
let's have a quick look. Can we just brokers' prices in the UK are always very different because they sort of create this sort of weird cash price. But around 24, 25 went down to on the cash VIX, and then it spiked up on Thursday to 40. I mean, it's a massive rise, really.
Yeah, it was up.
I mean, that's against
normal
lows of around 12. Is typically where we would be. Relative low, if you like. It's going to be a long while before we get down to around 12s again, I would think. That's for
sure. Almost certain. And I think to see that sort of jump, because the market basically fell 6%. This is the biggest candle that fall on the S&P, the Dow, and the Nasdaq. Remember, the Nasdaq made record highs early on in the week. And that fall, that's the biggest since early March or mid-March, when we're in the middle of the pandemic sell-off.
Yeah.
Incredible.
Well, in that candlestick, as one of the biggest falls, we're just looking at the Dow on this chart here, and there's probably only two candlesticks that are, bigger. Maybe that third one, 3 here, 3 bigger falls since early March, mid-March.
Yeah,
staggering, really.
Yeah,
and sort of just eliminates that previous sort of 2 weeks of euphoria, really. And you can see similarly with the S&Ps, and here we are today. We sort of dropped down a little bit, recovered a bit off those lows. So why have we been falling a bit more today? Because we had a bit of a relief rally, a bit of a recovery on Friday, didn't we, Jerry? And here we are taking out those lows again.
Yeah, do you know what, Friday though, if you looked at it in the last 3, it didn't hold it though. And it did sell off, and at one stage it was down on the day and then recovered in the last sort of couple of hours. But it wasn't the best of performances on Friday, although it did look like that early on in the afternoon. But over the weekend, I saw these numbers announced over the weekend regarding the infection rates in the US. They got 25,000 new cases over the last 24 hours. And the infection rate in Texas and Florida, southern states, I don't know why southern states are particularly, I think they felt they're more able to unlock and get their economies going, but they had record rise in infections over the weekend.
I mean, that's worrying when you've got a lot of states looking to sort of really reopen. I noticed from an article, well, some of them have decided to put it on hold. Utah and Oregon, I think they were looking to today, but they've actually decided to put that on hold now because of what's happening in these other states. Really.
Yeah, but I know it's alarm bells. They'll be ringing. I mean, I think when the US comes in sort of later on this afternoon, earlier this afternoon, I'd love to see what's push the fast forward button now, just to show you what's going the sort of effect of news like that. maybe they'll try and sort of explain it away, but I think it's quite tough because everyone's talking about when is the second spike going to come along, and we were talking about it earlier on. This actually could be just an extension of the first sort of wave, because they hadn't actually dropped and had that, low in infections, or nothing like in Europe and the UK. And I just I do find it interesting.
You can't help but think that, I mean, the US sort of locked down to a lesser extent than the UK, I think, only a few weeks after we did, and yet they're probably opening up quicker than
definitely. They're 2 weeks ahead of us. Some of the states started.
Trump's just rolling the dice to just hope everything will be okay, and then hopefully he can, get another 4 years. I don't know.
Well, he's probably calculated that a failure of the economy is more likely to dent his election prospects in November than having another 25,000 deaths. I mean, I know it sounds horrendous, Adrian,
and China, I suppose, can't he?
Well, he can do, and it's a bit like when you hear about Bolsonaro in Brazil. It's just nonsense, some of the stuff they're saying. It's almost a complete denial of the facts, calling it a little flu. And as I said to you before we came on air, that some of the comments about telling people to man up, I mean, it's almost playground behavior, which is quite similar to Trump, the way he shoots from the hip, from the Twitter mobile, rather than usual forms of government. One of the things that happened over the weekend, Adrian, that did make me laugh, Trump announced that he was going to withdraw a third of troops from German soil, which is about 10,000 troops. They've got another 20,000 there on top of that. And I was thinking at the time, gosh, that's quite interesting. And then the defense secretary, the German defense secretary, phoned up the Pentagon to ask, and they said they don't know anything about it, which is extraordinary. That's where the nerve center of the US military is. They knew nothing about Trump's tweet, which is
bizarre, isn't
it? It is. In some ways, I'm going to miss that sort of weird focus of people's ire. I mean, Trump is just I just wonder whether he realizes how much he's ridiculed globally.
Yeah, he probably doesn't care.
Well, no, he doesn't. He's definitely got some psychological disorder that means he's totally impervious to other people who've got a lot more rational views of things. But his mind, it's impossible to know what he's thinking and why he's doing things. That's really it. Anyway, on a little bit from Mr. Powell, I did actually joke with someone the other day. I said that it's more likely that whilst Jay Powell, who put the cat amongst the pigeons, he's the chairman of the Federal Reserve, Adrian, and he was the one that sort of painted this rather depressing outlook. And Trump obviously is always contradicting him because he wants the economy to be doing well because it'll improve his election chances, etc. And of course, whilst Trump contradicted him, you could say that Jay Powell, it's a case of don't shoot the messenger. All he's doing is telling you as it is. That's his job as the central banker. But someone has said that the chance that it is possible that Jay Powell will still be in his job come Christmas, whereas Trump may well not, which is so. I wonder whether Trump will try and get rid of Jay Powell before the election. Because he may not be doing anything after the election because he won't be in power.
Absolutely. Well, it's interesting. I mean, the polls now putting, where are we? The page is gone. Where are we? General election. Here we are. There's a couple of polls putting Trump ahead, actually, weirdly, but whereas actually a lot of these polls really putting Biden quite some distance ahead.
Yeah, the poll that I've seen has got him just over 10% ahead, Biden.
Yeah.
Although, that's some of the more recent ones.
Yeah, things can change.
They can do. They can do. So the other effect of what's been happening, as I said, is the dollar. But an interesting move is in sterling, Adrian. That's something we should also mention because that obviously is more relevant to us here in the UK. And it suffered a bit of a double whammy last week because of the shockingly bad GDP data. And I think this whole Brexit thing. It's not really sort of progressing much. I don't know what impact the failure of the talks to progress is having. I'm just not sure at this stage. But maybe if Johnson does inject some sort of momentum into these talks, he's got this video chat with the president of the commission. That's it. Of the EU, and you never know. It may unlock a few things. I'm not sure, but
I can't help but think that the markets will become rather immune to a lack of progress at some point on the understanding that they'll sort it out in the 11th hour. We talked about this last week, how the European Union has a history of agreeing stuff at the last minute. But we know this, so why get our knickers in a twist if it's just going to be agreed?
And just to make it very clear, I think the UK played the right hand by, I think, Gove signalled to the EU last week that the UK would definitely not be seeking the extension, and the extension has to be granted by the end of the month anyway. And if we don't seek an extension, there's no way the EU are going to be positioned to grant it by the end of the month. So I think that just says where we're going, or where the UK is going, and the fact that these heads do need to be knocked together, because the 11th hour is the 11th hour. It's not, well, maybe it'd be the 11th hour next year or the year after. No, it's this year.
Yeah. So let's just get on with it.
Yeah. God, please do. I thought we had escaped it. Mind you, I was the one that brought it up.
That's true.
So I dare you.
All right, so let's quickly then have a look at the calendar for the week ahead. Then, Jerry, there's a few bits in there for sure. Do you want to run us through those?
Yeah, it's a little bit quieter than last week. We've already had the industrial production numbers from China, slightly better than predicted, but remember, China, they've a remarkably positive run of, they hadn't had any infections in Beijing for, I don't know, was it 30 or 50 days? I don't know, something like that. But then now they've got a second.
Sure they haven't.
Yeah, of course they haven't. They tell us no. Why would you not believe them? Anyway, they have had a rash of new infections in this wet market that's biggest in Asia, apparently, and that's causing a few concern. But anyway, apart from that, nothing really of note, apart from, as I said to you, Boris Johnson's meeting by video link with the EU Commission President to try and get these Brexit talks going. Tuesday is the first sort of interesting one, another central bank meeting. We talk about what's affecting these markets. It's government largesse and central bank largesse. And this is the reason why we focus on central banks, because they really are what's driving a lot of the moves in these markets. So if we don't talk about them, you're going to be missing out on some of the key sort of bits, really. But so Bank of Japan tomorrow, Adrian, or overnight. They've got a 2-day meeting, no change in rates. They're so negative, it's just not going to happen. But the governor of Japan, Mr. Kuroda, he's going to clarify how aggressive they're going to be. And this is all going back to what all the other banks are going to be doing. If they're not cutting rates, they're doing something with quantitative easing. No different in Japan. They committed to buy an unlimited amount. So not 600 billion, 700 billion, whatever it is. In Japan, we'll buy as many as we need to. And that's unlimited. And believe you me, in Japan, wow, have they got debt. It's sustainable debt, but the pile of debt in Japan, they've got a lot of stuff they could buy. So anyway, but other than that, little impact sort of expected, really, unless Kuroda says something that's not expected. So that's the Bank of Japan. We then have retail sales in the US, a pickup in retail sales, but you'd expect it because they've sort of been gradually easing their lockdown. And all I would say is, at what risk to a second wave, or at what risk to an extension of the first wave? It's that trade-off, lives against economic hardship, really.
Yeah, absolutely.
And then this Fed chair Powell testifies. You think, chair? What's his chair got to do with it? He is the chairman of the Federal Reserve. He testifies, presents his testimony to the House Financial Services Committee in Congress, and it's this semi-annual monetary policy report. It's quite interesting, but what they tend to do is they release the text of what he's saying, literally as he stands up. So the market gets all of it in one fell swoop. So it'll be interesting at 3 o'clock on Tuesday just to see what he's saying. He's got 2 days of this, so you'll see on Wednesday, Adrian, again at 5 o'clock in the evening, our time that is. He talks again, and it's a 2-day testimony. And but the first day is normally the interesting one. I think they get a.
And we can see the impact from last week of what he can say and what can happen as a consequence.
Definitely high impact. If you don't know what these central bank governors and chairmen are doing, then you could be missing a few tricks. It's normally quite market moving stuff. Wednesday, inflation data in the UK, CPI. Look at that, back round again. Another month of lockdown. Wow. What is it? Another fall. It's sort of heading to the same sort of region problem area that the Eurozone's got. And it's funny, I'm quite a bit older than you, Adrian, so I come from the baby boomer years, and our parents suffered the consequence of rampant inflation in the 1970s, 1980s, and it became a really, really dirty word. And taming inflation was the major success of the late 90s, noughties, the death of inflation. But of course, inflation actually is a good thing. If you run a business that makes widgets and you knew that you could not increase the price of your widget because of price pressures, what chances are that you're going to invest in your business? So economies do need inflation. They need a certain level of inflation to help oil the machinery. Not too much, not rampant inflation. Inflation got out of hand with OPEC and massive increases in oil and energy. But this is the opposite happening now. And I think it's a big problem. And that's the problem for the UK. We're falling into that same issue. On the one hand, you've got governments and central banks spending vast amounts of money supporting the economy. You'd think it would stimulate inflation. Maybe that's in the years to come, Adrian, but it's certainly not happening now, is it?
Absolutely not. No.
And of course, that'll affect the thinking at the Bank of England, and that's why. And we're going to get onto that in a second. Talk about negative interest rates. Gosh, that's not going to help much. Anyway, well, we could talk about it now. In fact, the monthly policy meeting from the Monetary Policy Committee. That's the rate setting committee of the Bank of England. No change in interest rates. Well, you might think, well, how on earth could they cut rates from 0.1%? Believe you me, they can. They could. They're not going to, but they could cut them negative. And that's where a lot of speculation is starting to build that the bank may cut rates to below zero by November. And some of the money market instruments are pricing one in by March next year. So it's somewhere between November and March that negative interest rates will happen, possibly. But we are going to get an increase in the quantitative easing program that the Bank of England runs. It's currently at 645 billion. They're doing another 100 billion. What's that to you and me? We'd all like a share of that 100 billion. And the answer is it filters through to us somehow, but probably, anyway, in different lots of sort of measures that don't always affect us individually, but does help the economy in general. So that'll be keenly anticipated, Adrian. And of course, midday is when it all is all announced.
So definitely some quite big central bank elements this week, isn't there? Yeah, and then finally Friday, UK retail sales, which where are we? Well, it's core. Well, looking at 6.3% at the moment.
It's a rebound, but given the expected lockdown, you'd expect a better rebound perhaps than that. I don't know. I mean, remember, this is a month-on-month change, Adrian, so you're not going to get 18% fall in May's number.
No,
it's certainly slowed down. It's actually different to the number I originally had.
Back open today, though, haven't we? So it's normal sort of non-essential retailers back open today, though.
No, that's right. Anyway, hopefully the easing of the lockdown is going to herald some even more positive news when we report on the retail sales this time next month. So let's keep our fingers crossed, everyone.
Yeah, absolutely. Right, I think that's pretty much it for us this week, everybody. So as ever, we'll be back next Monday, the 22nd of June. So please tune in for another Trend Signal podcast. But in the meantime, everybody, have a wonderful week's trading. Hopefully you make lots and lots of profits, and we'll see you next time. Bye for now.
Yep. Bye now.